Whether you're a believer in the timelines or skeptical about its urgency, the energy transition is underway and its ramifications immense. It's been estimated the adoption of new technologies translate into a $200 trillion opportunity over the next 30 years. Yet the numbers hide varying geographical approaches between Europe, Asia, and the US. Politicians, from my perch, are virtue signalling and often naive in their expectations about timelines, and the investment industry all too keen to jump on the bandwagon and create products that may not survive investment examination. We had Michael Bersham, McKinsey's head of corporate strategy, in an interview in January last year, discuss the transition top-down, but consultants don't manage money. And so today we wanted to go to the coal face, if you'll excuse the pun, and we asked several allocators who we respect who they would recommend to have as a guest and a highly regarded investor. And the answer was the gentleman sitting in front of me today, someone who thinks that Tesla could go bankrupt, talks about the failings of the wind industry, all wrapped within his unequivocal view of the need for this transition to accelerate. And we hope today to understand who he thinks are the winners and losers, what his firm, Clean Energy Transition, and its two funds are seeking to identify. So Per Lekander, here with us in Marylebone on this fine May morning. Welcome to the Money Mates podcast.
Thank you very much. I'm glad to be here.
Well, you are our first Swede, which is in itself great for us. There are, as I said, some critical areas to discuss, and it makes, having read your materials and knowing what we're going to talk about, a very interesting discussion and an interesting counter to Anne Davis from BP, who was here a few weeks ago for our interview. So from renewables to electrification to motor cars, we want to cover some essential ground for our investing and other listeners. First of all, Per, you are a Swede, 30 years of experience investing across the global energy spectrum. You were head of global utilities research at UBS, where you received a number of awards for industry and company analysis. You managed the 1.3 billion utilities fund at Norge Bank, and you launched the Energy Dynamics Fund at Lansdowne in 2015 before moving to be the founder and PM of Clean Energy Transition. But let's reverse for a minute. Explain your journey from Sweden to the UK.
When I was 13, 14 years old, was not uncommon. I got an absolute fascination for cars, and in particular for engines. So I decided I want to become an engine developer. And, I'm from the west coast of Sweden, and Volvo is in Gothenburg. So I was all set of starting out being an engine developer at Volvo. So I went to the local technical university, Chalmers, was very ambitious. I was all set of getting a job once I came out on doing engines. And, we were like 250 in the class, and I think I graduated as number 2. So I thought, this is all set. I came to Volvo, and remember, this was 1986 at the peak of Swedish socialism. So I got the answer of that, no, you don't get the job. We don't want people who have only the left side of the brain. Which I think is very unfair because, my other great passion outside of work is playing the violin. So I thought I should qualify, but I didn't. Anyway, so it became a shock to me. What do you do? I had kind of had this ambition for 10 years and nothing to do. So I had, generally I'd studied, of course, very kind of hardcore fluid dynamics, thermodynamics, combustion technology, etc. But I had taken one course in something which was a bit business. And this was with a very dynamic professor, Holger Bolin. Some who are local might know Bolin and Strömstedt. He was the biggest accounting firm at the time of the country, and he founded it. So I went to him and asked, can you offer me something while I figure out what I should do? So he offered me a job. I was at the university, so I was partly studying and was partly doing working in order to finance it. I was there for 3.5 years. I got a higher degree, and then I saw an ad in the paper, and it was to move to Stockholm of the Royal Academy of Engineering. So I jumped on it, and this was kind of energy policy. So we were, working on issues on taxation, on R&D policies, etc. And it was really fascinating. And, for instance, I was I was working for the first chairman of the IPCC, so the UN's climate committee, and that was quite interesting because this was 1990, and thinking back of it now, they were absolutely spot on. I don't think the science has developed much. Of course, it has developed on making it deeper and more convincing, but in terms of forecasting what would happen, that's really bit. So from that point, I realized there is something which is now called the energy transition. Anyway, I did that for 5 years. I'd never been abroad, so I thought I need to get abroad. And one of the people I worked with, he was chairman of the International Energy Agency. And so I said, I want to work a job there. And I got a job, so I was still only 30. And this was the most senior non-political job you could have at the IEA. So all my colleagues were 50, 60, and there was I. And I had a great time. My family, however, were not that happy to be outside of Sweden, so we moved back. And then I thought, okay, I can't be a civil servant. I have to do something else. So I recruited for and got a job at McKinsey. And, it took a couple of weeks. And then they realized, oh, this guy is very well connected in kind of oil and gas utility space. We make him a specialist only working on these issues. So therefore, I was with McKinsey until 2004, so 8 years. And I was really doing M&A and regulatory work globally. I calculated I worked in 38 countries during that period.
Oh.
And of course, didn't see my family much, but I had a good time. McKinsey was a great firm, but I didn't really enjoy consulting that much. Some of the work was very important, but some of it was really to bury an issue more than having a result. So then I was contacted by a previous McKinsey colleague, Luisa Masategui. Cygnus Capital. I think they've closed down now, but they were a competitor for many years. And anyway, he said, you should come to UBS. And so I became a sell-side analyst. And that was interesting because, then I was close to 40 and I got a senior position. So I was competing with people who had been doing the work for 15 years at least. That was challenging because, I had learned quite a lot of finance at McKinsey. I could do a discounted cash flow valuation, etc. But I had never, ever built an integrated financial model because, of course, you had a project. You did a project there. So it was initially challenging, but I worked hard and I used my strengths, which was that I actually knew these companies, which the others didn't. And so I became number one in 2 years, and I had a great time on the sell side. But after some years, I realized I want to move to the buy side and actually put money at work because I thought I was pretty good at calling stocks, and I got the issue when you move from the sell side to the buy side is of course that normally you get into an analyst position and then you work yourself up and eventually you manage money. I wanted to manage money. And somehow the Norwegian Sovereign Wealth Fund believed in me and gave me a pot of money to manage. I must say I was very impressed with Norges because this is a organization which is. It was at the time 2 times the Norwegian GDP, so it's probably 4 times the Norwegian GDP now. But he was not political at all. He was very professional. So I had a good time. However, one day I got a call from Pete Davis at Lansdowne, and I had known him for a significant point of time when I served him while I was on the sell side, and he, Lansdowne had been running a financials fund, and he thought that there is some sort of disruption going on in the energy space. That should be possible to do long short money. You are the perfect guy to do it. I jumped on it, and I was thinking that, might fail, but you will not regret that you tried. And it might succeed. So I started there mid 2014 to set up a fund, and had a 1-hour crash course from Pete in how to run a hedge fund, and then off you go. And we started with 20 million, and we are on that journey. So the two funds I'm currently running are the ones which started at that point in time. It's just that we broke out into a separate legal structure a couple of years ago, which is now Clean Energy Transition. So that is my journey.
Okay, so you've answered 5 questions in one, which is absolutely terrific. So that's very economic. And of course, the coincidences are that Pete Davis we know well. He's been a guest on the show and is a good friend of ours. So that's one link. And secondly, of course, Nikolai Tangen, who now runs the Norwegian Sovereign Wealth Fund, was not only a guest, we hosted a dinner for him at one of our podcast dinners, and to talk about how he views the world along with other guests, which is fascinating. So just tell us the size of the assets that you're running and the number of people and how you would ultimately distill your mission.
Right. So we have around $2.7 billion AUM. 2/3 of it is in the hedge fund, and a third is in the long only. The long only is more or less replication of the long book in the hedge fund. When I started in 2014, I dare to say now, 10 years later, that I probably didn't know that much about hedge funds. Of course, I had served them on the sell side, but it's a different thing to run it.
Yeah.
And so therefore, in terms of objectives, etc., I, to a large extent, replicated Pete Davis Fund. So I would call it one of Europe's few fundamental hedge fund, and it's a proper hedge fund. Another thing I discovered when I looked at competitors, etc., that most hedge funds are not hedge funds. It's kind of almost long only products charging 220.
Yep.
Our objective is to manage to achieve 10% net return, and it should not really matter if markets go up, down, or sideways. In terms of the organization, of course, we're outsourcing as much as you possibly can outsource. So it's really only a kind of investment and marketing we're doing, and we are 14 people.
And if you were to describe your core processes, how would you describe those?
So first, the name of the firm is Clean Energy Transition. The idea is that we are a thematic investment manager trying to make use of this change, which is clearly happening. We are not religious in any way. If you can make money on oil and gas, we are trying to make money on oil and gas, but we think there is a direction of travel here. What I firmly believe is that you cannot make money through just buying cheap stocks and selling expensive stocks. The market is not that stupid. Of course, you get mispricings in a shorter period of time, etc. But in order to have genuine alpha, you must somehow have a view about something changing. So our investment process is really about identify those thematics where we think there is a change. If I take one now, for instance, because I think you alluded to it initially, that after several years of disaster, we really think that there is a genuine recovery in the wind turbine industry. And so we are identifying the thematics. And then in parallel, of course, you're making a job on stocks and on industries, etc. But it's kind of the thematics which govern what you do. And then from the basket of potential stocks which are kind of exposed to that thematics, we put the best ones on. That is kind of my idea.
Great. And we're going to dive into a few of these. Let's just start at 500 feet. You have written dramatic transformations are occurring as our society shifts from a reliance on unsustainable to sustainable energy sources. But we all know lots of hype, wishful thinking, separating fact from fiction is hard. Can you summarize where we are on this journey? Because some would say it isn't a transition right now, it's an add-on.
So thank you. Let me first just say, and again, I'm not religiously green in any way. I am, I think, however, a good analyst. And the reality is that this change is absolutely needed. I'm coming back to this that already in 1990 I worked on climate change, and so far the forecasts are absolutely spot on. It's a bit ridiculous when we see these political statements about 1.5 degree goals, etc. We were already at 1.5 degrees last year, and there might have been some temporary issues, so it might go down to 1.2, 1.3 now. But as we are right now, we are on a journey towards 3 degrees, and at 3 degrees, Southern Europe are deserts. Some areas in the Middle East and in India, etc., are probably inhabitable, and we are going to get migration flows as a consequence of this. So this change is needed, and if we can contribute to speeding it up, that is hugely important. So where are we in this transition now? We have actually tried to develop an index for this, just to put some sort of reference on it. And we put the index as 2000. The energy economy had of 2000, and 100 or 100% would be that we have a fully sustainable carbon-free energy system. And we have just passed 20% of that journey. I think our latest index was around 23. So this is developing by currently around 1.5% a year. So if I just extrapolate it, we would come to a situation that we have probably reached the goal of sustainable energy system somewhere 2070, 2080, something in that range, which is too late to avoid the horror scenario I mentioned, but that's where we are.
Okay, so if we think about the alternatives, you've touched on wind, but I'm going to quote you. You say, I'm worried about wind. Projects are being shelved, turbines are failing, global turbine manufacturers are loss-making, but wind energy demand is growing by 10% per annum. And so here you go. This is a typically what I would call as a pithy Swedish comment. Global wind stocks would at least double from here, and Siemens Energy in particular will do much more than that. So reconcile kind of the problems with the opportunity.
So I'm stepping back to where I came from, consulting into the sell side and then doing more normal financial analysis. I think financial markets, in particular in growth industries, are too focused on growth. We want growth, for sure. That's very important to have a good story. But what we also want, we want margins. And margins is a consequence of course, good operating companies with profit maximization and optimization as good goals and behaving in rational way. But we also need industry structure, which is recent. You need a certain level of oligopolies to be clear. Not illegal levels, but legal levels. And I think that is the problem for many growth industries. And the wind industry has been a typical example of it, that if I go back, let's call it from 2005 or so, costs just went down very, very quickly. There were a lot of capital, so there were many startups, many companies. So what you ended up with here is companies which were just massively focused on growing, focused on just coming with new products all the time in order to lowering costs, very little differentiation, too fragmented industry structure. Therefore, what you have had since 2018 is really a normal shakeout process. Companies have gone bust, failures have occurred because the stuff was not tested. And now, in my view, you have come to a situation of The companies have realized that it was wrong. You can only have a sustainable future if you are profitable, and the industry structure has concentrated, and you have the kind of 3-4 players you want to have in an industry. And that then coincides with that growth really is taking off. And in particular in developed market, in Europe, largely as a consequence of the energy crisis we had a couple of years ago, and in the US, largely as a consequence of the financial kindness which has been provided by authorities.
Got it. So from and within that, you've obviously identified in your work, it's a matter of public record, that Siemens Energy is your preferred name. Then I read about your solar comments, and your opening comment was the solar complex is uninvestable. But then within a paragraph, you're talking about how First Solar is an exception. So again, just high level, what's going on in solar, and then dive down a little bit to the individual.
So solar is a very good example of what I just said. Demand growth is huge. Its growth, it doesn't have 10% CAGR. It has like 15-20% CAGR. So it's not that demand is not a problem here. The problem is there is essentially no differentiation between the companies. It's a genuine commodity. And then the other problem, which I think is a very easy way to assess whether an industry is investable or not, is the role of China. China is over 80% of the global solar industry. And here you have a country where everything is subsidized. You're not paying for the land, you're not paying for the capital, you have no profit objective really. It is just for growth's sake. So no one else can compete. Go back. The solar industry, photovoltaics, that was a German invention. It came from the Fraunhofer Institute. And if you go back 15 years, it was German companies which dominated. Yeah. But then you have this Chinese, and this is something I react to. It's not that the Chinese are cheaper because they are better. It's not. It is because they don't have any return requirements. The people are cheap. Everything is cheap. And so therefore, as long as that goes on, you can't compete. And I think we're in the early days of it, but I think something similar is developing into EVs. So now I come to the First Solar story. There is one country in the globe which have kind of realized that you can't compete with the Chinese because they are playing in an unfair game. And that is the US. And it was Trump, really, during his period, he introduced a 290% import tariff on Chinese solar panels. And now Biden followed through, and there is actually plans now to raise this even further. So what has happened is that US has become an island market. You can't really do anything unless you are in the United States. So therefore, you have created the industry structure, and First Solar is the leading player in this domestic industry structure. Of course, there is a risk if these barriers to trade would disappear, the story is over. So in the investment case, sizing, etc., you have to, of course, consider this fact of that they are living a very good life because of rules. On the other hand, I can say that there are very many things I'm uncertain of. One of the things I'm least uncertain of is that US policy versus China, if anything, is going to get tougher, not softer.
Okay, we agree on that. We may not agree on the next topic, because as I read your commentary, and I do not claim to have any great insights, I paused on your thesis for natural gas. And if I've understood it correctly, you're quite bearish about gas. And we had Ann Davis and BP. I was listening to a really interesting podcast that Nikolai Tangen did with the CEO of Shell, Wael Sawan. And I was just talking to a friend who's back from Asia who tells me, and he's in the energy industry, the demand for gas is growing and it's growing strongly. It's replacing, on the one hand, coal. On the other hand, as you will know, but the latest NVIDIA processor chip used for AI consumes more power per year than a 4-person Western household. And at the same time, on the supply side, a lot of work is suggesting that we might be at what has been known as the Hubbards peak, so gas deposits, not being as prolific as was thought. And the gas prices come down a long way. Obviously, there's this difference between Asia and Europe. And I'm looking at it and reading people much, much smarter than me and thinking that a bit like the uranium play, which I participated in, is that gas looks pretty interesting. So where are those emerging gas bulls, even if we accept it's a little early, where are those gas bulls wrong?
So those gas bulls are wrong because, so first you're saying, gas from, you mentioned BP. Mm-hmm. Gas has, of course, been and become the lifeline for several of the oil majors. I think BP actually is the least one. It's even more if you look at Shell and Total, if you think about Europe. But my point is that some 10 years ago, when big oil companies saw that probably the outlook for oil is not that great and it's better for gas, they throw an enormous amount of money into gas, mainly into liquefaction and capacity, and mainly in North America. That capacity is about to come online. You're going to see almost a tripling of LNG capacity starting towards the end of this year, and then over the next 3 years. That coincides with a situation where renewable growth is accelerating. And if you think about what is renewables really replacing, renewables are not replacing oil. Oil is a fuel which is used for cars and on the margin, power plants in emerging markets, but that's really on the margin. What more electricity is replacing is the use of gas. If we just think about here, for instance, it doesn't make any sense to install new gas heating in this country. It is way more efficient and starting to become way cheaper if you do something, to just do electricity and heat pump. And so gas demand is going to surprise on the downside at the same time as the supply is really, really accelerating based on decisions which were taken 10 years ago when the outlook was very different. So I'm not saying that gas is going to go away. I'm saying that there is going to be very, very limited pricing power. There is, of course, one caveat to what I'm saying, and that is that we have an ongoing war in Europe, and Russia is a major player in gas markets. Of course, a lot of their exports have been cut out, but they still have significant exports to Western Europe, mainly through liquefied natural gas. So we could have another pop. But to be a structural bull on gas markets, I really, really struggle. I should say one thing more on the upstream side of gas. Gas is usually the byproduct of producing oil, and in particular in shale plays, almost half the calorific value is coming from gas. But the oil part is so profitable that you're essentially selling the gas at any price. That is why you have so very low American gas prices now. So you get gas where you're not interested in profitability of producing it, and then to get it to the customers, liquefying it to get into the customers, that system is exploding at the same time as the demand is relatively weak. I agree with you that if I'm wrong and gas is really proliferating, really replacing coal, in particular in Asia, more than I believe, that would be good for the globe. But I'm not sure it's going to happen.
Before we leave that, how do you respond to the intermittency problem of winds not blowing and sun's not shining and AI centers and everything else needing to run?
So that is the big issue for a renewable focused energy system. It's not producing the electrons, it's producing the electrons at the right time. And if you think about storage medium, like, take a battery, for instance, a battery can do quite a lot day to night, etc. But, like if you take wind, you can have periods of weeks where it doesn't blow. Batteries don't do anything. And unless we have some technology development which looks very far-fetched, it's not going to solve it. So you need other types of generation. First, is not a barrier to where we are right now, with the exception of possibly of some small islands, because we are, in most situations, you have renewable penetrations of 20-30%, and as long as the markets are interconnected, you typically can deal with it. But if we go up to 50, 60, 70%, you have issues, and if you go even further, you have real issues. So most likely, I believe that we will try to run existing nuclear plants for as long as possible. That I think is going to happen. And we will need an awful lot of gas turbines. It's just that those gas turbines are going to run at very low load factor. We did a very good modeling of this. We looked at Texas, because if you think about Texas, it's very extreme, both from supply and demand situation. If you take demand, demand spikes massively in July, August, when, of course, it's very hot and the air conditioners are running flat out. And on the supply side, it's largely a thermal system. It doesn't have help of large scale of hydro or anything flexible. And we came to the conclusion of that if you have 90% renewables, you probably need around 2 times as much flexible generation as you currently have. So it's not that you would think about that renewables increase, therefore you need less of the rest. You actually need more of the rest. It's just that it's lower, runs very few hours. So, a bit of baseload from nuclear, an awful lot of gas turbines. Ideally, of course, they should be fueled by hydrogen, but they can probably be fueled by gas as long as load factors are low. And the intermittency problem is exaggerated.
Okay, well, I remain long of the Sprott Uranium Fund myself and long of Cameco, and believe that uranium is absolutely key. And you've talked about batteries, which leads us right into automobiles and the future of the car. I was quite excited about this. I think lots of listeners will be fascinated because you have some strong views. But again, let's just start top level. I may be wrong, but my understanding is the world right now produces circa 80 million new cars a year. Capacity might be above 100 million. And yet there is resistance in many quarters now towards electric vehicles. There is also, we were seeing it in the West. Yes, a lot of younger people don't want to drive cars. Just tell us high level before we get into names. How do you describe the playing field for cars globally?
So there is no doubt about that. The car industry has been a terrible industry for decades. And I think, again, in many cases, I think that the investment wisdoms, which are, let's say, really useful, they are few, but they are very, very, very effective. The problem with the car industry is that you produced more cars than the consumers wanted to have. So therefore you had to dump them to Hertz or to whoever, and therefore you didn't get pricing on anything. That is very clear. What is also very clear is that COVID was an absolute blessing to the auto industry. because what the managers, and I should probably say on the first step, a key reason why you have overproduced cars is that cars is exactly like airlines. It's a flag industry. You know, if the car company goes bust, the government bails it out. So you never get the normal development.
Clearing,
However, COVID was a blessing because suddenly you had real constraints on the availability of cars. So, suddenly, instead of producing, I would say they had been producing like 92 million, suddenly it went down into the 70s. And what the car companies realized was that their profitability went through the roof when they produced much less, because suddenly they got pricing power. And the investment question is now, will the industry manage to sustain this? Will they realize that they collectively are better off not dumping cars than not, or are they going to go back to the previous? That is the key question. So far, they have managed supply quite well, and therefore pricing has been great. Then you have this second issue, which is of course this transformation to electric vehicles. And there, my view has been all the time, and it remains. The problems of this have been vastly exaggerated from an auto industry perspective. Yes, it's a significant change, but it was a significant change to introduce fuel injection or emission controls or all the safety measures as well. They have handled this. Why wouldn't they be managed to handle the transition to EVs? I think the problem to EVs is on the value chain, that suddenly you need to build a new industry in terms of the whole battery chain, etc. Otherwise, I think that change was exaggerated. And that is to go over to my investment case here, that I said initially that I don't believe in a strategy of buying cheap stocks and selling expensive stocks, because there is a reason why stocks are cheap and expensive. But I believe that there is the concept of bubbles in markets. And they occur all the time, very rosy expectations about something, and eventually they deflate. And in an existing product, per definition, if you have a bubble, you have got to have an anti-bubble. So an anti-bubble meaning that you have unreasonably negative expectations about something. And that is my point, that developed in the auto industry. And I think we can say what the reasons were. Number one, a lot of the companies went bust in GFC, GM, etc. Number two, Volkswagen ended up in Dieselgate, which was a massive cost and created a big problem. And then third, the emergence of Tesla. This is someone who just took off in a different direction. Because here, if I take a company like, I'm taking Stellantis, the former Peugeot, former Fiat, etc., Jeep. We can debate whether it's a fantastic company. I think everyone is in agreement that it's extremely well run. If I look at estimates, no one really seems. It might be that they thought that the earnings over the last couple of years were a bit exaggerated, but people believe that they're going to make 10% operating margin, and revenues go up a bit. It has around 65 billion market cap. It has in excess of 30 billion of net cash on the balance sheet. In a bankruptcy, not everything of this would probably be available, but say 15 is available. And it trades on 3.5, 4 times PE, or 15-20% free cash flow yield. And then I make an exception to my valuation case, because then I only build my DCF, and I come to the conclusion of that if this company survives for in excess of 5 years, it will have generated cash flow, which are in excess of the market cap. And no one believes that this company is going under. So the valuations are totally obscene. And you are actually paid to wait, because what you get here is that you get 6, 7, 8, 9% dividend yields. And in addition, you get like 3, 4, 5% buybacks. So you get 10 to 15% total returns if you do not change the valuation. And eventually you manage to say this valuation is going to go up. So that is my investment case, that it does not make sense that quality auto companies trading cheaper than oil companies. The only companies I've found which really, really are cheaper than quality autos here now are coal stocks. And then I think we're all in agreement of that they have a limited life.
Got it. Now, in reading your materials, and we have asked the Stellantis CEO to come on, by the way, and we haven't got him yet, but maybe after he listens to you, he'll feel he has to come on and talk
I think
about
he should.
Okay. You're very interested, I think, in Mercedes. Just tell us what's going on there, and you made a number of points about battery life, etc. But tell us about the new Mercedes.
Yeah. So with the new Mercedes, we have to go back to the old Mercedes. I'm thinking back of when I was a kid. My father was relatively successful engineer, but I remember his pride when he 1975 drew up in front of our house in his brand new Mercedes S-Class. The problem with Mercedes was that it in the late 90s, early 2000s, tried to go down market and came with all these A-Class and B-Class. Mercedes was no longer a way to signal that you had made it in life. It was a car which was available for everyone. And then, of course, you ended up with quality problems and the models were unprofitable. We got a new management team in 2018. And they haven't said it this way, but my interpretation of it is really restore the old Mercedes. Restore what is Europe's probably strongest brand. Produce a bit less cars, make it impossible for normal people to buy it, and therefore reattain the status symbol what it was. And this strategy is going very, very well. Margins have been going up. Profitability has been going up significantly. And I think there is way more to go with this. And here again, there exists this American study of the value of brands, and of course Apple is at the top, etc. There is only one European brand which was in the top 10, and it was Mercedes-Benz. And they put the brand value at, I think, 75 billion, which is equal to the market cap. I think they put the brand value of Apple to 100 billion, which would be something like 3% of the market cap. And now, so Mercedes is recovering, and now they have, of course, a super strong balance sheet. Again, close to 35 billion of net cash. So they are distributing 100% of the cash flow to us shareholders through a combination of dividends and buybacks. And actually, today, when we record this, is the annual meeting of Mercedes. So the accelerated buybacks start tomorrow. So from tomorrow and until January, they're going to buy back around 7% of their daily trading volume, day out and day in, on a stock which is trading at around 6.5%, 6.5 times PE. I can guarantee you it's going to go up.
So before and as we now move to EVs, if I understood it correctly, their new MMA platform you discussed, these might have batteries that run 1,200 kilometers. So it's a game changer. They're not unique, because I think Toyota's working on a solid-state battery as well. So just give us a look into the future about the car.
So I think what has been a problem was for the other automakers was the success of Tesla. Because the success, and in particular the market cap, means that everyone panicked. and accelerated their development of EVs significantly. That means that a lot of the cars we are seeing here now, they're going to have very poor resale values because the new generation are going to be way better than the previous.
Yep.
So now the somewhat, let's say, setback in Tesla is probably moderating. So I think the new car is a process of 10 years, but you are absolutely right that whether Mercedes truly masters the electrification or not, we will know next year, because there is really the time where the cars come, which were not kind of haphazard, rapid developments in order to make up for regulatory requirements, and that the market resisted it. So let's see. I'm very, very confident of that this company, which created the car in 1890, survived 2 world wars. Actually, the world's most valuable car ever sold, 300 Gullwing Olab, was sold last year for 225 million. That car was manufactured 1953, 8 years after the country was absolutely flattened.
Yeah.
There is zero reason to believe that Mercedes has been technology leader for 120 years. I think they're going to be technology leaders for the next 120 years. But that remains to be seen. And while you wait, you're getting an incredibly cheap stock, with increasing earnings.
And if we just stayed with the industry, is it just fair to say, therefore, we have 2 segments? We have a luxury segment and we have a mass market segment. You own Stellantis, I believe, in your fund, but you also own Mercedes. So how does one think about those 2 segments?
Yeah. So again, go back to the kind of the basics here. What are the basics ways for how you compete? Either you compete through differentiation, or you compete through lower cost. Those are the only basic strategies which work. Differentiation is, of course, I shouldn't say it's easier because it's difficult, but let's say it's generally more sustainable. And Mercedes' strategy is clearly differentiation. And so it's the normal, either your Hermes handbag or whatever, it's the same. I think generally low cost is a very tricky strategy. It's, it works for a while and then the others catch up. But I think Stellantis has a real potential to match Toyota, which has really succeeded with a low-cost strategy, because Stellantis is now so differentiated geographically and brand-wise, and they really seem to have a culture of just constant cost-cutting. They are not petrol heads. They just want to make money. I think, let's see, I think the CEO Tavares has been very, very instrumental in accomplishing this culture of profitability over just manufacturing numbers. I think he's turning 65 next year. Let's see, he says he's still committed, and I think that is really critical for as long as that happens. And I think this is a fantastic story, but it is a story of lower cost, at least outside of the US. In the US, there is elements of differentiation around Jeep, etc.
Got it. Let's turn to Tesla. Hand in the air, I tried to short Tesla twice, and it was a very painful experience for me. You have been, maybe still, short Tesla, and you were on the CNBC the other day talking about why it's, my word, not impossible that it could go bankrupt. And at the same time, I see Elon Musk said the other day, if you value Tesla as an auto company, then you fundamentally have the wrong framework. Yeah. If someone does not believe Tesla will solve autonomy, you shouldn't be an investor. Tell us what you think is going on at Tesla.
Yeah. So first, it is an amazing story. If you think about the peak, 2021, Tesla had a market cap of 1.2 trillion. At that point in time, it manufactured less than 1% of global cars. And it had a market valuation which was around 2 times the combined market value of all the other there. So you can't justify it, and it's been put into Magnificent Seven. But think of it: Nvidia has operating margins of 80%. Apple has operating margins around 50%. Microsoft is similar, around 50%. Tesla was at the peak at 15, and now they are at 5. You can't have the same valuation on a company manufacturing physical products as you have if you're doing software. As simple as that. And 92% of Tesla's revenues are coming from selling autos. The other 8% are coming from selling batteries or solar panels. The revenues which are coming from the Dojo supercomputer or this self-driving, etc., are essentially none. And so let's first stay with the auto business. This company was at the peak making around 10 billion of EBIT, and this year they're probably going to make like 3 billion of EBIT. That is, the 10 billion of EBIT is around 50% less than Mercedes is making. Mercedes has a market cap of 80 billion, and Tesla is now 550 billion. So, clearly the auto business, you can't make any sense of it, and it doesn't make any sense whatsoever. So you have to justify it with other products, and the other products, they just don't exist. On the self-driving car, and it's of course very dangerous to have strong views about the future. We all know about how what was it? IBM thought that the combined number of photocopier in the world would be 5, etc.
Yeah, so McKinsey thought there were only, according to Mike Milken, who's on the show, only 1 million sales of mobile phones ever.
Yeah, exactly. So that's very dangerous. What I think is pretty clear is that technology is one thing, regulation is a second thing. And why I am very convinced about that self-driving cars in urban environments is going to take a long, long time is because of the regulatory situation. Just what happens when the car drives over a person here on Marylebone High Street. Even the legal situation is really unclear. So there can be a role for self-driving cars, or let's say on long-distance highway transport, etc., but that they would be robo-taxis. Let's put it this way: I don't think the London taxi drivers should be very afraid of robo-taxis. That is very long to them. So you can't really value this. And on the rest, it has no moat. So my take on Tesla is that it is very similar to Bitcoin. It is just an instrument to express risk. That's the only way you can explain it.
Now, let's just push you a little bit on the fact that it's one thing having the wrong valuation, it's another thing going bust. And they've been able to raise capital that was just defied expectations.
Yeah. So I actually don't think so, for two reasons. So first, if you buy into my argument of saying that these side businesses, so AI and self-driving, etc., they are side projects. Perhaps they are valuable in 10, 20 years' time, but right now you can't really consider them. What would be a fair valuation of Tesla? So let's not say that this year is going to be very bad profit. I take the peak profit. So let's say 10 billion EBIT. If you would value it like an auto company, you would put it like if Mercedes trades on 3 times EBIT. If you take an industrial company, a normal industrial company, it trades on 10 times EBIT. So 10 times 10 billion, that makes 100 billion, but the market cap is 550 billion. So for sure, once the bubble goes down, the stock goes down a lot. So, I think Tesla today is at 175. Any sensible valuation would be, call it 10 to 50.
Yep.
And once you get down, one thing which has really confounded me all the time is this fact of that, there are so many situations around Tesla which have been totally outrageous, and they have had no legal consequences. I have to mention a few of them.
Yes.
So the first one was around Solar City, which is now integrated into Tesla. There is a scene, and it's really hilarious. He's standing it looks like a Spanish courtyard with tiles around him, and he says, "You think it's tiles, but all these are solar panels." If you think back, there was a real belief in that Tesla was selling solar panels which look like tiles. That has been proven and verified. Number two, I think it was 2018 where he had his 420 secured. He tweeted out that he had an offer on the company at $420, and from the sovereign wealth fund of Saudi, and Saudi sovereign wealth fund has confirmed it never did it. On the full self-driving cars, they have claimed that there is a video in 2019 where it says they have solved it, and he raised money on the basis of this. This is not solved. I was personally on a conference call on an equity raise 2019, where he said that towards the end of next year, which would be the end of 2020, Tesla would have 1 million self-driving cars on the road. It did not happen. And then go on to some other issues. If you think about the board, we calculated that the chairman of the board, Mrs. Denholm, she has sold stock of $350 million. Normally in a board, compensation are in the hundreds of thousands. Here, the compensation has been in the hundreds of millions. There was a ruling from the SEC that he should have a Twitter sitter. Someone should verify before he put something on. It has not happened. So, all these examples, why have there been zero legal consequences of this? My take on this, or our take, I should say, because I'm working together with my team, is that, you never take down a stock on the basis of legal cases. A stock goes down because it has operational problems or management problems, something. But once a stock has fallen, legal cases can finish it off, because then someone has got harmed. The problem with, if you take the 420 take private tweet, was that the stock went up. There was no harm inflicted. I can't, or you could not, as shorting the stock, claim harm. That you have a class action suit. So once the stock falls significantly, let's call it 75, 50, and you had people who entered the stock at 300, then there is legal merit. So we need the bubble to recede for normal business reasons, etc. But once it has receded to a more normal valuation and therefore gone down by another, call it 60, 70%, then it's going to get finished off by class action.
So the question I have is the management of risk. I could not hang on to my short Tesla position because it was too painful. How have you managed the risk where he goes off to China and the stock's up another 10%?
So, this is an extreme case of something which is very general. It's one thing to have a view, and it's a different thing to make money on it. And so what you have to do is that you have, of course, to be very active on these issues. And some people have said that, you should get out because you have lost money in the past. We have actually not lost that much money in the past, because we have tended to be, let's call it 3 to 4 times bigger on the way down than on the way up. But we haven't made money. But the advantage of being involved in a stock for a long period of time is that you learn a lot about it. And so when he goes off to China, it's I shouldn't say the word here. Let's call it BS then. I'm not too inappropriate. But you also know that the stock is going to go up. So then you need to panic. The advantage with this stock compared to many others is the liquidity is unbelievable.
Yep.
It is truly, truly unbelievable. You know, our fund is not small, but we can close our short position in, I would say, 1-2 minutes.
Yes.
And so it is. I actually think there are other stocks shorts we have which are potentially more dangerous because you couldn't get out of them. And so you need to be aware of that. This is your end game, but you are participating in a trade, and therefore I would say technicals are very important.
Got it. And just for reference, we've had, and for people who are interested in the shorting, which is almost a dying art, we had Carsten Block from Muddy Waters as a guest talking about how he manages shorts, and we had Chris Dale from Kintbury, which is a European long short, and both of them were very sensible in their articulation of how they deal with it. Now, there are a couple of other important issues. One is the metals for the energy transition and how we think about what else is required. I think I noted you owned Albemarle, and maybe that's wrong.
So it is wrong. We have both been long and short Albemarle in the past. Right now we are on the sideline.
Okay, but if I, as a rank amateur, look at what the world needs more of. EVs require 4 times as much copper as a petrol car. Electricity grids will need 20% more copper alone between now and 2040. This is all, stuff that I've read from people who know what they're talking about. And it requires 3 times as much copper to generate the same amount of electricity on a solar farm as on a gas-powered station. And then we've got the Ukraine rebuild. At a high level, looks to me like there's a lot of demand for copper coming and there isn't the obvious supply. Do you own it? Do you care? Can it sit in your fund?
So let me add to it that what you said is absolutely true from the energy transition angle. But then you have the whole AI thing, and it leads to the same conclusion. So I totally agree with you. First, general on metals. I find metals being hard, because metals is in most cases linked to chemistry, and chemistry is changing. I'll give one example that if we move back 5 years ago, we read all the time about cobalt as being a kind of a scarce resource, and you had, and it was all in this Central African Republic, etc. Cobalt has essentially been eliminated now. There are other metals. If you take lithium, for instance, let's see where we end up. But many, including Toyota, are working very seriously on eliminating lithium and having sodium instead. So there, it is dangerous for many because the technology is so fluent. Then we come to copper, and copper is almost impossible to replace because of conductivity reasons. Because we will need conductivity, and the only thing which is better than copper are precious metals. And I don't think National Grid want to build a transmission line in gold. I don't think that's going to happen. So
they will please our sponsor, the World Gold Council.
Yeah. So I agree that the demand for copper looks extremely solid and growing. If there was a setback, I think it's something you probably should buy. I want to make one comment on this, because on the energy transition, we have been thinking a lot about where is it less uncertainty? What are the total no-brainers? And I think that a no-brainer is everything which has to do with the electrical infrastructure. Whether it's transformers, the wires, the switch gears, because the energy transition, one way of expressing it is electrify whatever you can electrify. And that's a lot. And then find some solution for the few areas like air travel, etc., which you can't. So that looks very safe. And the other macro trend, which looks very safe, is that this information technology is just going to expand. And the electrical infrastructure is intersecting both of them. So, companies like Schneider Electric, Eaton in the States, you mentioned before Siemens Energy. It traded down on the basis of that it's doing wind and was a disaster, but the main business is really transformers, etc. That, I think, is the technological change will not impact. They will win anyway.
You maybe partly answered that, but one of your clients who's been a guest on the show, Charlotte Thorne from Capital Generation Partners, said that you've done a lot of research as a team on AI and power demand.
Yeah.
And perhaps you could share some of your findings and data points around that.
Yes. So we did, because there has been a real hype, if you look on stocks now, on anything which is supplying data centers, nuclear producers or even gas producers or renewables. And I think now I don't remember who it was. I wonder if it was well, anyway, there talks about that we are running out of power as a consequence of AI. So we were really assessing what is the power demand. And, of course, it's uncertain, it's the future. But we took really many different approaches to it. And we have come to the conclusion of that AI until 2030, it can add something like 150 terawatt hours of power demand. It sounds pretty much, but then think in the context, 150 terawatt hours. That's the consumption of my home country with 10 million people. It is. We are forecasting that there will be 3,000 terawatt hours of power demand growth until 2030. So it's a bit small contribution, but it's actually not big in the bigger context. To make a comparison, it's roughly the same power consumption as Bitcoin could add.
Got it. Per, we've talked about a lot of things, so we may just have to simply say at some point in time you come back. So I'm going to ask you a few closing questions. How will you judge your venture as a success 5 years hence?
I judge it as a success that we continue to serve clients in a good way. We are a boutique. Level of AUMs is not the KPI to me. KPI to me is that, of course, you need a sufficient AUM to make the business sustainable, but we are definitely there. And if we do good work, it should grow a bit, but that's not the key. But the key is that we have good risk-adjusted returns, that we feel that we actually help our companies to move in a good direction, financially and environmentally, and that we have fun.
What advice would you give to a 20-year-old Per Lekander?
So I was thinking of when I said what I had done myself, that I had focused on something, in this case, building engines. I came out in the job market, and response was, we don't want you. So my take is that don't be afraid of that things don't really pan out. What is important is to have very good basic skills, good at math, good at communication, good at let's say processes, etc. It's the basics, because the basics you will not learn later, or computer stuff, etc. That is very, very important. And then the second one, just do what passion says you should do. That might change over life, and then you change career.
You said, and I'd just like to clarify I understood it correctly before we started the recording, that there are more billionaires per capita being created in Sweden than the US in the last, What period was it?
So there were currently, so I read this actually, a colleague sent this to me this weekend and I read the article. There were there were double the intensity of billionaires in Sweden compared to the United States, which I think was kind of surprising.
Right. That's per capita.
Per capita,
exactly,
of course.
Exactly. You let slip also that you loved, one of your passions is the violin, and with whom would you most like to play and where in the world if you could?
So I still think it would be Itzhak Perlman. He's now, you probably know him, he sits in a wheelchair, I think, and he's born 1945, so he's old now, but he's still from time to time playing, but he's very, very funny. And the reason I would like to play with him is that when I was in the military in Sweden, and this was 1982, I think. Itzhak was playing in Stockholm, and I was doing my military on the West Coast. So I traveled up to Stockholm for this concert, and the concert was, of course, in the evening. But I arrived a bit early, just before noon, and I had heard an interview with Itzhak Perlman when he had been in Stockholm the year before, and that interview had happened from Grand Hotel. So I took a chance. I went to Grand Hotel and was going to had bought a record and would ask the concierge to ask Itzhak to sign it. As a coincidence, he just arrived at the very moment when I went into Grand Hotel, and there I was. I was like 18 years old. What does this superstar do when someone, a young guy, comes up with and wants a signature? I just want to go to my room to clean up a bit, but would you like to have lunch with me afterwards? And I think that is the most extraordinary moment in my life, to have had lunch with him. So now I would like to play with him.
Fantastic. Well, no more questions because that's a lovely place to stop. Per, thank you so much for being with us today.
Perfect. Thank you very much.
All content on the Money Maze podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.